Welcome to The Explainer. What if you could actually profit from a stock market crash? Or make money even when your favorite companies are having a really bad month? Well, today, we're going to break down the investment strategy designed to do just that.
So let's kick things off with a classic problem, a problem that every single one of us has to wrestle with as an investor.
You know how it is. For most of us, investing feels like a one-way street, right? When the market's up, we're all happy, we celebrate, but when it goes down, our portfolios pretty much go down with it. It kind of feels like we're just along for the ride, holding on for dear life. But what if there was a strategy that lets you play both sides of the field? I mean, a way to have both an offense and a defense working for your portfolio at the same time. Okay, let's dive into exactly how that works. It really all boils down to two fundamental moves. On one side, you've got going long. That's the classic stuff we all know. You buy something because you think its price is going to go up. But on the other side, you have going short. And that's a way you can potentially profit when you think an asset's price is actually headed down. So how do you actually put these two kind of opposite ideas together? Well, some really sophisticated investment funds are built entirely around this concept, blending long and short positions into one powerful strategy. To see how this plays out in the real world, we're going to take a peek at one specific example, the QSIF Equity Long-Short Fund. Their whole goal is to blend these two approaches, going long on the assets they think are going to win, while at the same time shorting the assets they believe are going to underperform. So what's the first major benefit? Well, it's about reducing volatility. The goal here is to smooth out those wild swings we see in the market. The idea is, when your long positions take a hit, your short positions are designed to kick in, potentially generating gains that can help cushion that blow. Second, you get this really enhanced diversification. Because your short positions are literally betting against certain assets, they can act as a natural hedge. And this can really help reduce those painful portfolio losses, what the pros call drawdowns, especially during those really tough market conditions.
And third, and this is a big one, this strategy opens up a totally new way to generate returns, or what the pros call alpha. See, you're not just profiting from rising prices anymore. You now have the potential to profit from falling prices too, creating a completely different source of potential gains.
And this table here, it just illustrates that strategic trade-off perfectly. In a red-hot, raging bull market, a long-short strategy might actually underperform a traditional long-only fund. But look at the other side. In a market that's correcting or just chopping sideways or volatile, or even in a full-blown bear market, well, that's where this strategy is really designed to shine.
Now, that all sounds great in theory, but how does a fund like this actually decide what to buy and what to short? Let's pop the hood and take a look inside the engine room. Okay, so the process is this constant three-step loop, and it's all driven by a proprietary analytical framework they call Markov. Now, while the exact recipe is their secret sauce, its job is to constantly scan the market. First, to find the winners to buy. Second, to identify the laggards to short. And third, to always be managing risk and keeping those drawdowns in check. At the heart of their whole process is an approach they call systematic active investing. And honestly, the easiest way to think of it is as a partnership. It marries the cold, hard, data-driven logic of algorithms with the seasoned experience and intuition of human portfolio managers. The whole point here is to create a system that is structured and rules-based, so decisions aren't just based on a gut feeling. But at the same time, and this is so important, it's also designed to be adaptive and flexible enough to respond when the market throws a curveball. It's really about getting the best of both worlds. So what's the fuel for this engine? Just look at the breakdown on this chart. A whopping 70% of the data that's driving these decisions comes from something called high-frequency analytics, or HFA. In fact, the fund itself calls HFA its timing oracle. And this is basically the central nervous system of the operation, processing billions of data points in real time. We're talking trade data, liquidity flows, all to spot these tiny shifts and fleeting opportunities before they become obvious to the rest of the market. It is all about speed and precision. So, after taking a look under the hood of this pretty sophisticated strategy, what's the big picture here? What should you really take away from all this? Let's just boil it all down. At its core, this strategy is all about getting more control. By aiming to profit from both rising and falling markets, it's trying to smooth out the ride and reduce that crazy volatility. And as we've seen, the modern way to do this is with a powerful hybrid, combining human expertise with the raw, brute force power of high-speed data analytics.
And this really leaves us with one final thought to chew on. As technology becomes exponentially more powerful and data becomes more and more accessible, is this deep fusion of human insight and machine intelligence going to become the new standard for how all of us invest?